हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 32, 107, 109 which talks about financial instrument part 5. Previously we had discussed in 4 sessions about this standard. Like we had discussed previously about the definition of financial asset, financial liability, equity. Then we had discussed about the derivatives. Then we had discussed about option. Then we had discussed about difference between future forward. Then we had discussed about the classification of financial asset, financial liability, and its measurement principles. How to measure financial asset, how to measure financial liability, how to measure equity. Then we had discussed about the remeasurements, reclassification of financial asset and financial liability. Then we had discussed about some of the concepts like transaction cost. What is transaction cost? And these we had discussed along with some of the examples. So today we had discussed some of the concepts like accounting mismatch. Then we had discussed about the concept like transaction cost, how transaction cost along with some examples. Then we had discussed about the concept of compound financial instrument. Then we had discussed about accounting treatment where stocks are held as stock in trade, where shares are held as stock in trade. Then we had discussed about some concepts in Ind AS 32. What Ind AS 32 talks like which deal with the presentation of financial instrument, how a financial instrument is to be presented in case of equities and versus liability. Then we have discussed about the key concept of Ind AS 32, that is substance of transaction, how it's to be evaluated. We will discuss all this concept in this session today. So let's start our topic. Concept of mismatch in this standard. What does it mean? Like a company has invested in 10% bond. If a company has invested in 10% bond which is funded by company by issuing 8% डिवेंचर, लाइक अगर कंपनी ने किसी बॉन्ड में इन्वेस्ट किया है तो अगर वो फंडेड है थ्रू डिवेंचर्स, लाइक थ्रू 8% डिवेंचर से लोन लेके फिर कंपनी ने इन्वेस्ट किया है एट द रेट 10%, और अगर अपने अकाउंटिंग करते हैं उस कंपनी का एज पर इंड एस, तब अगर लोन को रिकॉग्नाइज करे एट एन अमर्टाइज कॉस्ट, because it will satisfy, it is a financial liability and it should be recognized at an amortized cost, either at amortized cost or fair value through profit and loss account. और फेयर वैल्यू थ्रू प्रॉफिट एंड लॉस अकाउंट में अगर लाइबिलिटी रिकॉग्नाइज करनी होती है तो दो क्राइटेरिया रहता है, वो है हेल्प फॉर से डेरिवेटिव के केस में दिस इज अ लोन, purely a loan, so it should be recognized at an amortized cost by default as it is a financial liability. In the other case it is invested, this loan amount is totally funded to the investment in 10% bond. So अगर 8% का कंपनी ने लोन लिया है और 10% का इन्वेस्टमेंट किया है इन अ बॉन्ड, उसी लोन अमाउंट से इन्वेस्ट किया है और लोन को आप एमोटाइज कर रहे हो, लोन को रिकॉग्नाइज कर रहे हो एट एमोटाइज कॉस्ट और इन्वेस्टमेंट को रिकॉग्नाइज कर रहे हो एट फेयर वैल्यू थ्रू ओसीआई, तो एनी गेन और लॉस, इंटरेस्ट को आप रिकॉग्नाइज, लोन का जो इंटरेस्ट है आप पे कर रहे हो उसको आप रिकॉग्नाइज कर रहे हो इन पीएल, और इन्वेस्टमेंट का जो इनकम आ रहा है उसको आप रिकॉग्नाइज कर रहे हो पीएल में, because it is classified as fair value through OCI. Any investment, because ये investment को आप classify करो at fair value through OCI because it satisfies the condition, like business model test to collect and sell will get satisfied and SPPI also gets satisfied. That is why this investment is a financial asset and it will be classified as fair value through OCI, and any interest income is recognized in profit and loss account, and any gain, fair value gain or loss, is recognized in case of fair value through OCI in OCI. So these differences, बिकॉज इंटरेस्ट इज लोन का जो इंटरेस्ट है वो रिकॉग्नाइज हो रहा है पीएल में, इन्वेस्टमेंट का जो इंटरेस्ट इनकम है वो रिकॉग्नाइज हो रहा है पीएल में, लेकिन एनी गेन, फेयर वैल्यू गेन और लॉस का जो डिफरेंशियल अमाउंट है वो रिकॉग्नाइज हो रहा है इन केस ऑफ इन्वेस्टमेंट इन 10% बॉन्ड, वो रिकॉग्नाइज हो रहा है इन ओसीआई. सो ये कॉन्सेप्ट जो है ये अकाउंटिंग मिसमैच कॉन्सेप्ट है. दिस इज कॉल्ड एन अकाउंटिंग मिसमैच बिकॉज अकाउंटिंग मिसमैच होने के कारण यहाँ पे डिफरेंस आ जाता है. तो कंपनी, सो दी स्टैंडर्ड, ये स्टैंडर्ड ने बोला कि आप क्लासिफाई करो, कंपनी को बोला कि कंपनी कैन क्लासिफाई सच डिबेंचर एंड इन्वेस्टमेंट at fair value through profit and loss account category to avoid accounting mismatch. In these concepts, financial asset and financial liability will be designated at fair value through profit and loss account. Such designation is at the option available to the management. बोला है कि ये स्टैंडर्ड वो आपको ऑप्शन दे रखा है, अगर ऐसा कुछ अकाउंटिंग मिसमैच हो तो आप उसको, उस ट्रांजेक्शन को आप फेयर वैल्यू थ्रू प्रॉफिट एंड लॉस अकाउंट के में क्लासिफाई कीजिए इन ऑर्डर टू अवॉइड अकाउंटिंग मिसमैच. बिकॉज वो मिसमैच होगा तो प्रॉब्लम अराइज होंगे. इन ऑर्डर टू अवॉइड दिस सिचुएशन द मैनेजमेंट विल डिसाइड, मैनेजमेंट का डिसीजन है, एट द ऑप्शन ऑफ द मैनेजमेंट कंपनी कैन क्लासिफाई सच डिवेंचर एंड इन्वेस्टमेंट एट FBTPL category in order to avoid accounting mismatch. So it is at the option of available to the management. So management will decide whether they will classify such accounting mismatch at fair value through profit and loss account category. In our previous session, we had discussed about the transaction cost. What is a transaction cost? It's an incremental cost. In case of financial asset, it should be added. In case of financial liability, it should be reduced from the value of the liability. So we had discussed about the financial asset, the transaction cost in case of financial asset, which we had discussed in our previous session, in session 4. Now in session 5 we are discussing about the transaction cost in case of financial liability. Like if financial liability is there, how transaction cost is to be recognized. So this is to be explained with the help of examples, so it will be more clarified. Like XYZ Limited has taken a loan of rupees 60 crores from Axis Bank. Axis Bank charges rupees 5 crore as processing cost upfront from XYZ Limited. How to discount for such transaction cost under Ind AS if the term is 6 years. So in this case, XYZ Limited is a company. He has taken a loan of 60 crores from Axis Bank, and Axis Bank has charged 5 crore as an upfront fee for sanctioning such loan, and the discount transaction cost, in order to discount such transaction cost as per Ind AS term. How to discount for? And the term is 6 years. The loan is taken for 6 years. The rate of interest is 20%. So how to discount such transaction? How to recognize such transaction? So loan taken is 60 crores. Processing cost is reduced in case of financial liability because for XYZ Limited, it's a financial liability. Loan is a financial liability. So they will reduce these processing cost from the value of the liability. 60 crore is the value of the loan taken and processing cost is 5 crore. So it should be reduced. So net loan taken is 55 crores. Now how this is to be discounted for? In year 0 there is a cash inflow of 60 crores. Because the processing fee is to be deducted, so it becomes 55 crore in hand for XYZ Limited. But interest is to be calculated on the total amount of 60 crores. So interest is at the rate 20%, so it becomes 7. Principal plus interest is to be payable over a period of 6 years, so it becomes 12 crore each. So there is a cash inflow of 55 crores, but cash outflow along with the interest for the organization, which is 12 crores each. In each year, they had to pay 12 crores. So in year one, they are paying 12 crores. The opening balance for the organization is 55 crores. Payment becomes 12 crore. Interest is to be charged. Effective interest rate. So how to calculate effective interest rate? By using trial and error, where cash inflow is equals to cash outflow. I had mentioned this various times, like by using trial and error method, we have to find out the effective interest rate. But in this case, I am using the Excel method. So we will go to the Excel in order to find out the amortized cost. So let's start. This is our Excel where I will find out the effective interest rate by using IRR method. In this, there is a function IRR where we are finding out the effective interest rate. So the effective interest rate becomes 8.28 percentage on which interest is to be calculated. Opening balance is 55 crore where interest is to be calculated at the rate 8.28%. Now on opening balance we have to calculate the interest component at the rate 8.28%. Like in this case we had calculated on opening balance at the rate effective interest rate 8.28%, which becomes 4 crore 5561 446, which becomes the interest element. Now the amortized cost, that is the closing balance, becomes opening plus interest minus payment, because the installment is to be paid at 12 crore each in each year. Amortized cost becomes 47 crore 55 lakh 61 446, which becomes the opening balance in the next year, and interest is to be calculated on that. In this way the interest is to be calculated and the payment is to be made at 12 crore. So the amortized cost becomes, so in this way we will calculate the interest and amortized cost every year, and at the end of year 6 it becomes 0 because all the installment is to be paid. So in this way the amortization table is to be prepared for loan. So this is the amortization table for loan. In this way the table is to be prepared. Now the counting of transaction cost, where the loan to be draw down in future. How the counting is to be done? When the loan is sanctioned by the organization but it is not drawn, it will drawn in future, not instantly. When the drawdown of loan is probable, when there is a probability that they will draw down the loan after sanctioning, then how they will recognize such transaction cost shall be treated as prepaid expenses, because transaction cost incurred today but loan is drawn after some period of time and the probability is there that they will draw the loan. In that case the transaction cost shall be treated as prepaid expenses to be presented in the asset side as current or non-current asset. Like the entry is to be done, prepaid asset account debit to bank. When the when loan is drawn down at the time when actually the loan is to be drawn, the loan is sanctioned in year 1 but it is drawn in year 2, actually drawn in year 2. So when actually the loan amount is drawn, then that time that transaction cost will be netted off from the loan amount. And interest, as usual, it should be charged at an EIR, effective interest rate. But when the drawdown is not probable, after sanctioning the loan, when there is no probability, the probability is less. In that case, such transaction cost is also recognized as prepaid asset account debit to bank, but such prepaid asset shall be charged to PL on straight line method, because the probability is less in that case that they will draw the loan. In that case, that prepaid asset is to be charged to P&L on straight line method as processing cost account debit to prepaid expenses on SLM method. But when there is a probability that there is a probability is high, probability is means highly probable that they will draw the loan, then such transaction cost is to be reduced from the value of the loan when it is actually drawn. But when there is no probability, when probability is not there, but the loan is sanctioned, but then such transaction cost will be recognized as prepaid asset, and it should be charged to P&L on SLM basis every year as processing cost account debit to prepaid expense. So in this way the accounting is to be done. Now accounting treatment where shares are held as stock in trade. If company invested in shares of various companies and such investments are held for trading, then whether such investment is dealt by Ind AS 2 or by Ind AS 109. If there is a company which is invested in the shares and such investment are held for trading, not for investment, it is held for trading, then whether such investment are dealt as per Ind AS 2 or as per Ind AS 109. Ind AS 2 says that scope out those investments held by broker for trading. Ind AS 2 says that if any investment is done for trading purpose by brokers, they are out of the scope. They are out of the scope of Ind AS 2. Ind AS 2 will not dealt with such transactions. Such transactions are out of the scope of Ind AS 2 if the investments are held by broker as trading. For trading purpose, these standards does not dealt with. But Ind AS 109 says that if any transaction, any investment is done by broker for trading purposes, then such transactions are accounted for as per Ind AS 109 as fair value through profit and loss account. And it should be recognized at fair value through profit and loss account because such transactions are held for trading and such transactions are held for derivative. And it is done by the broker, then it should be recognized at fair value through profit and loss account. Such investment by brokers are in the scope of Ind AS 109. So this in this way the accounting treatment is done in case of shares which are held for stock in trade. So it should be recognized at fair value through profit and loss account. And now if any transaction, Ind AS 32, what it says, Ind AS 32 deals with presentation of financial instrument, means how to present the financial instrument, that is equity versus liability. Presentation of financial instrument, how to present the financial instrument means equity, how to present the equity versus the liability. Ind AS 32 provides guidance for the perspective of from the perspective of issuer. If the issuer issuing any, so how they will recognize, how they will present that instrument in the books. So suppose it is from the perspective of issuer, not from the perspective of holders. Ind AS 32 provide guidance from the perspective of issuer. So suppose B Limited has issued preference shares to A Limited for rupees 1 lakh at the rate 10% for 10 years. So in the books of A Limited, who becomes a holder of that instrument, it should be accounted as per Ind AS 109, like it should be account for as per fair value through OCI or at amortized cost if it satisfies the condition, that is SPPI test or fair value through OCI held for sale, then it should be recognized as per 109. But in the books of B Limited, who becomes the issuer of that instrument, like they had issued the preference share, in that case they will recognize as per Ind AS 32 is applicable. Issuer, like for them Ind AS 32 is applicable for presentation of equity or liability. Whether it will be equity or liability, fixed to fixed test satisfied, then it becomes equity. If variable, if it is in the nature of variable, then it should be recognized as a financial liability. So it should be recognized from the issuer perspective and apply measurement principles as per Ind AS 109. Whatever the measurement principles as mentioned in Ind AS 109, like at amortized cost or fair value through profit and loss account, it should be recognized in these way only. So in this case, because it's a issuance of preference shares by B Limited, so it should be recognized, means the measurement principles is followed by Ind AS 109, and presentation is as per Ind AS 32 in case of in the books of B Limited, and in case in the books of A Limited, that is the holder who hold the instrument, it should be accounted as per Ind AS 109. Now the key concept of Ind AS 32. What are the key concepts are present in Ind AS 32? That is substance of transaction. How the transaction is to be evaluated. Evaluation of component of financial instruments. Transaction does not result in financial liability. Which transaction does not result in financial liability? Transaction which cannot avoid recognizing liability. Obligation to purchase its own shares. Putable financial instruments, then exception of putable financial instruments, then contingent settlements, then NCI put options, then compound financial instruments, then early redemption in case of compound financial instruments, then treasury shares, then dividend accounting. This is the concepts which we discussed in Ind AS 32. Step by step we will discuss about these concepts. Transaction, substance of transaction, what it says. Substance of transaction needs to be evaluated for equity or liability classification. Means if the substance of transaction needs to be evaluated for equity or liability classification. For example, mandatory redeemable preference shares is a financial liability and not equity. How the transaction is to be evaluated from the perspective of equity and from the perspective of liability. How it should be classified. It should be evaluated how the transaction is to be made. So mandatory redeemable preference share. If it is mandatory redeemable, that preference share is to be classified as financial liability and not equity, because it is mandatory redeemable. That transaction is mandatory redeemable at the end of year 10. If it is optionally redeemable, then it should be accounted as per equity, not as per financial liability. So suppose A Limited has invested in 10% mandatory redeemable preference shares of rupees 1 lakh for a period of 10 years in B Limited. Then in case of A Limited, that is the holder's book, it should be recognized as per Ind AS 109. Whatever the, it should be recognized whether at because it is mandatory redeemable. It will be redeemed at the end of year 5. So it becomes an recognized at an amortized cost. But in case of issuer, like in B Limited, it should apply Ind AS 32 for equity and liability presentation. In the books of B Limited, mandatory redeemable preference shares shall be classified as financial liability because there is an obligation, contractual obligation to pay cash is there, because it should be mandatory redeemable after. So there is a contractual obligation to pay cash arises in the hand of issuer. So they will recognize that a financial liability and not as an equity. Equity is that component where it should be no obligation in the hand of the issuer to pay cash. But in this case, there is an obligation. Mandatory redeemable preference share is an obligation in the hand of issuer to pay cash after the end of the period. So it should be recognized at an amortized cost. So bank account debit 1 lakh to preference share capital 1 lakh, because it should be redeemed at the end of substance of transaction is important in order to recognize whether it's a financial liability or equity. Now, component of financial liability. Component evaluation of financial instrument. In order to account for financial instrument, each component of financial instrument is to be evaluated. Suppose B Limited issue 10% convertible debenture to A Limited for rupees 1 lakh at the rate 10% for 10 years. So B Limited issued 10% convertible debenture to A Limited for rupees 1 lakh for 10 years. So it becomes a convertible debenture which will convert into equity at the end of year 10. So it should be recognized. It should be recognized at equity, because it should be converted into shares after the period over. So in this case, each component of financial instrument to be evaluated, because the interest component, whether it should be interest is also converted into equity or interest is to be paid in cash, it should be evaluated first. So in this case, company needs to evaluate whether these components are equity in nature or in the nature of liability. Whether at the end of year convertible debenture, it should be converted into shares or it should be redeemed at the end of year 10. If it should be redeemed, then it should be classified as financial liability, and interest is to be paid every year, then it should be classified as a financial liability. But if interest is not paid every year and it should be converted into shares, then it should be recognized as an equity. So firstly, we will determine the nature of transaction. In this case, company needs to evaluate whether these components are equity in nature or in the nature of liability. Compound financial instrument means it's a mixture of two or more elements. Mixture of two or more element means it's a mixture of financial instruments like financial asset, financial liability or equity. Suppose if B Limited has issued 10% optionally convertible debenture, it is at the option that it will be converted into debenture of rupees 10 lakhs to A Limited for a period of 10 years, then how it should be recognized? A Limited has an early redemption option. If the A Limited has early redemption option, how it should be recognized? If not redeemed, such debenture will be get converted into shares. It is at the option of the holder whether it will be redeemed early, whether they will redeem the early than the period, or it should, if not redeemed, then it should be converted into shares. Means होल्डर के पास आपके पास ऑप्शन है कि आप उसको रिडीम कर सकते हो या आप उसको कन्वर्ट भी करवा सकते हो इनटू शेयर्स. सो इफ देयर इज अ रिडम्पशन ऑप्शन अवेलेबल टू द होल्डर, अगर होल्डर के पास ये ऑप्शन है कि वो रिडीम करवाए, सो रिडीम मतलब there is an obligation to pay cash in the hand of the issuer. There is an right to receive cash in the hand of the holder. So it becomes, because there is an obligation to pay cash in the hand of the issuer, it becomes a financial liability in the hand of issuer. So in the books of B Limited, it becomes a financial liability. Interest component is always mandatory payable, so it becomes a financial liability. But if that debenture is converted into shares, and if satisfy the condition, that is fixed to fixed condition meets, then it will be treated as an equity in the hand of issuer. And if it fixed to fixed test fails, then it becomes a financial liability. In optionally convertible element debentures, if in the books of B Limited, in the books of issuer, it becomes a financial liability and also the equity, then it will be treated as a compound financial instrument. If both financial liability and equity features is there in a single instrument, then it should be considered as a compound financial instrument. In these case, split accounting method is to be followed. But if all the redemption option, interest payable and conversion option meets the criteria of financial liability, then it will be treated as financial liability because there is no element of compound financial instrument. But if it meets the redemption option is at the recognized as financial liability, interest payment is recognized as financial liability, but conversion option is, if it meets the fixed to fixed criteria and it should be recognized as equity, then it should be treated as a compound financial instrument because in a single transaction there is a element of financial liability and element of equity features, then it should be considered as a compound financial instrument, and in that case split accounting is to be followed. Now this is to be explained with the help of example. Like compound financial instrument is an instrument where there is a feature of financial liability and equity. In the books of issuer, it should be recognized in the books of issuer, like issue price is rupees 1 lakh, face value of the instrument is 1 lakh, number of bonds is issued, that is 100 bonds, coupon rate is 6%, term is 5 years, and it should be converted into one bond equals to 10 shares, which is mandatory converted, which is not at the option of the holder. It should be mandatory converted into shares after the period of 5 years. There is no option available to the holder. And the market rate of interest is of similar bond is 10%, because if the similar bond is to be, what was the market rate of that bond in the market, that is the 10%. So how it is to be accounted, how it should be recognized, how it should be measured, we will find out. Solution: in these financial instrument which is having both the features of financial liability and equity instrument, because the company is having an obligation to deliver interest in 5 years, because the coupon is there, coupon is to be paid every year, the company need to pay 6% coupon every year. So it should be treated as a financial liability because it is an obligation to deliver cash, and it is also having an element of convertible mandatory features like convertible debentures into shares, which should be converted into shares after the end of 5 years. So it should be treated as equity because fixed to fixed criteria is meeting, because number of shares is mentioned and also the price is mentioned, consideration is mentioned. So cash outflow every year becomes how much the cash outflow, how much they will pay, the company will pay as a coupon, that is 1 lakh pay 6%, that is 6,000 per year they will pay as a coupon. So they will firstly find out the present value of that coupon, that interest. So in year 1, year 2, year 3, year 4, year 5, they have the company's cash outflow will be 6,000 per year. So it becomes total 30,000 at the rate, because it should be factored at the market rate of 10%. So the rate of percentage present value factor becomes, discounting element becomes 10%. So it becomes 1 divided by 1.10, it becomes 0.90. In the same way, the discounting factor is to be calculated and the present value of cash flow is to be finding out. Like 6,000 multiplied by 0.091. So it becomes 5454.5455. 6,000 into 0.2826. So it becomes 4958.67. 6000 into 7513. So it becomes 4507. 6000 into 0.6830. So it becomes 4098.08. 6000 into 6209. So it becomes 3725.52. So the total cash outflow becomes 30,000. Present value factor at the rate 10%, which becomes 3.7901. And the present value of cash outflow, the total present value of cash outflow becomes 22,745. Now how it should be, how the amortization table is to be prepared for that, because there is a cash outflow of 22,745, because at the year end there is no redemption available for debentures, because it should be converted into shares, which is satisfying the condition of fixed to fixed element. So it should be treated as an equity, and equity is not, amortization table is not prepared for equity. So only for interest component we will prepare the amortization table. So present value today, the value of that coupon in the year 1, the opening value becomes 22,745, on which the interest is to be calculated at the rate 10%. So it becomes 2,274. Payment every year is to be made at 6,000. So the closing value will be opening plus interest minus payment, which becomes 19,019, which becomes the opening balance in the next year, and the interest is to be calculated, the payment is to be done, and the closing value arises. In the same way, we will prepare a chart for that 1, 2, 3, 4, 5 years. At the end of year 5, the closing balance becomes 0, because all the interest is to be paid by the organization. So it becomes 0. The step 4 is accounting entry of that. Firstly, at the year 0, the company will make an entry bank account debit, because because they had issued a debenture which is optionally converted. So bank account debit, they will recognize they had received 1 lakh. But how they will account for? They will account the component of liability. They will account the liability component of compound financial instrument, because the liability is only the interest component. So it should be recognized only the interest part, that is 22,745, and the equity component is the balancing figure, that is whatever the entity receive, and whatever the liability component is there, the remaining remaining amount becomes a equity component. In this case, 1 lakh minus 22,745, that is 77,255, it becomes the equity component of compound financial instrument. It is always becomes a balancing figure. Now interest is to be calculated every year. We had made the amortization table. On that we had calculated the interest, that is 2274 in the year 1. So we will make the entry like in year 1, interest expense PL account debit, which is also called as a finance cost, 2274 to liability component of CFI. It should be amortized every year in the liability component, and repayment from that liability component is to be reduced from that liability. So if the payment is made by the company, so it will be debit the liability component of CFI account debit to bank by 6,000, because they are not paying the interest, they are paying the amount, repaying the amount as a coupon. So year 2 will be again the same way, the entries to be made. Interest expense account debit 1902 to liability component of CFI, that is 1902. Again they had repaid, that is liability component of CFI account debit to bank by 6,000. Now year 3 interest account, interest expense PL account debit 1492 to liability component of CFI 1492. Repayment liability component of CFI account debit to bank by 6000. Year 4 year interest expense PL account debit 1041 to liability component of CFI 104. Repayment liability component of CFI account debit to bank by 6000. Year 5 interest expense PL account debit 545 to liability component of CFI 545. Repayment liability component of CFI account debit by 6000 to bank. In the same way, the interest is to be recognized, and in the year 5 when that equity component which is recognized as a balancing figure, it should be converted into shares. So how much shares it should be converted? Equity component is 77,255, which is debited. Equity component of compound financial instrument to equity share capital. How much shares are there? Because one bond, एक बॉन्ड के लिए 10 शेयर्स रिडीम होंगे, तो यहाँ पे आपके पास 100 बॉन्ड है, तो कितना शेयर्स रिडीम होंगे? 1000 शेयर्स. फेस वैल्यू उसका 10 रुपये. फेस वैल्यू बिकम, इफ यू रिडीम, number of bonds is 100 bonds. For one bond 10 shares is to be for 100 bonds. How much shares? It becomes 1000 shares, and the face value of the bond becomes 10, so it becomes 1000 into 10, that becomes 10,000. Equity component of CFI account debit by 77,255 to equity share capital, that is 10,000, to security premium, that is the balancing amount. 77,255 minus 10,000, that is 67,255 becomes the security premium, which is converted into this debenture is to be converted into shares after the year. So it is the mandatory conversion accounting treatment. But it is if it is the treatment is optional at the hand of holder, then how it should be accounted for? Illustration 2. If in the above example, if the financial instrument is not mandatory convertible, but convertible at the option of the holder, then how the accounting entry is to be done? पहले एग्जाम्पल में आपको मैंडेटरी कन्वर्ट करना था शेयर्स को, और इस एग्जाम्पल में, पहले एग्जाम्पल में जब इशूअर ने जो इशू किया था, कंपनी ने बोला कि आपको मैंडेटरी कन्वर्ट किया जाएगा शेयर, बट इस एग्जाम्पल में कंपनी ने बोला कि ये होल्डर के हाथ में है कि वो उसको शेयर्स में कन्वर्ट करना है कि रिडीम करवाना है, ये होल्डर के हाथ में दे दिया गया. तो दैट केस how the accounting entry is to be done. Year 1 to 5 cash जैसे in the form of interest आ रहा है. Year 5 में प्रिंसिपल इन कैश, और या तो आप कैश में रिडीम करवा लीजिए अपना डिबेंचर्स को, या आप उसको कन्वर्ट करवा लीजिए इनटू शेयर्स. सो इन ईयर 1 to 5 their company is paying cash in the form of interest, and in year 5 it is at the option of the holder whether he will redeem the debenture in cash or he will convert that debenture into share. So in the books of issuer, how it should be accounted for? In the books of issuer, issue price is 1 lakh and face value, the same example I am taking, the face value is 1 lakh, number of bonds is 100 bond, coupon is 6% and term is 5 years. Convertible ratio is 1 bond equals to 10 shares. Option to convert into shares at the decision of the holder. And the market rate of interest is 10%. Step 1 is to find out the present value of cash outflow in the books of issuer. Like in every year they have to pay the cash outflow of 6,000, which is the coupon, that is 1 lakh 6%, that is 6,000 per year as an interest. cash outflow for the organization, that is 6,000 every year, and at the end of year 5, they if they have an option to redeem, then in that case they will also add the principal amount, that is 1 lakh. So it should be discounted at present value factor at the rate 10%. So the cash outflow, present value of cash outflow for that is 84,837. Along with these instruments, there is an option to convert the shares. So the remaining, it should be account value of option. The step 2 is the company's the present value of the redemption option is 84,837, and the remaining amount will be 15,163, that is 1 lakh minus itna, that is 15, that is the value of option attached to the contract. The present value of the means option which is attached to the contract, that is 15,163. If any option is attached with the convertibility debenture or preference shares at the hand of holder, then the remaining amount is to be treated as a value of option. In this case, we have to find out firstly the present value factor of all the amount which is to be delivered by the organization, that is 6,000 coupon every year, and at the end of year 5 the principal amount, that is 1 lakh. The present value factor of that is 84,837. The remaining amount will become the value of option. So present value of cash outflow, the present value of cash outflow for the organization, present value, that is present value of cash outflow becomes 84,837 is the present value of the cash outflow which will incur. What was the outflow incur after 5 years, the present value of that, and interest is to be calculated at the rate 10%, that is 84,837 at the rate 10%, which becomes 8488, and the payment is 6,000 every year as a coupon, so the closing balance becomes 84,837 plus interest 8484 minus payment, that is 6,000, which becomes 87,321, which becomes an opening balance in the next year, and interest is to be calculated at the rate 10%, that is 8732. Payment is to be done, that is 6,000, with the closing value becomes 90,053. In the same way, the accounting interest to be done, the amortization table is to be prepared, and at the year closing value becomes 1 lakh, because all the interest is to be paid, only the principal amount is left, that is 1 lakh. So in these 1 lakh, how the accounting entry is to be done? Year 1 में accounting entry is bank account debit by 1 lakh to liability component of CFI, which becomes the redemption value plus also the principal value, the present value of the principal amount, and also the interest component, that is 84,837. And the equity component of CFI is the balancing figure, that is 1 lakh minus 84,837, that is 15,163. This is recognized as an option, because if the holder will opt to convert the shares, then how they will account for. So in year 1, 2, 3, 4, 5, they will recognize the interest expense account debit to liability component of CFI, and also make the repayment of liability component CFI to bank by 6,000. In the same way, they will make the entry year 1, 2, 3, 4, 5, and in year 5 they will also make the, if the holder exercise option to convert, if the holder will exercise the option to convert in year 5, so how they will account for? Liability component of CFI becomes 1 lakh, equity component of CFI becomes 15,163. So liability component of CFI account debit by 1 lakh, equity component of CFI becomes 115,163, and the whole amount is to be converted into shares because the holder opt to convert into shares, and it will convert the shares because the fair value of that shares, the bond is 100 and the fair value of the bond is one bond is converted into 10 shares, so it becomes 1000 shares, and the face value of the bond becomes 10, so it becomes 10,000. So it should be converted to equity share capital at the rate 10,000 to balancing amount becomes the security premium. If the holder opt to convert the debentures into shares, but if the holder opt to redeem, then how the accounting entry is to be done. A liability component of CFI is 1 lakh, equity component of CFI is 15,163. Because he is not opting to convert, then what the bank account debit is by 1 lakh, because actually the company is paying 1 lakh only. But the remaining amount, the equity component is transferred to retained earnings, that is 15,163. But if they are opting to convert, then that amount is to be converted into shares, and remaining amount is to be transferred to security. In this way, the accounting entry is to be done if the holder opt to exercise to convert or redeem instrument 1. Having an instrument while holder of FI is getting, then when the having an instrument when holder of फाइनेंशियल इंस्ट्रूमेंट, जो कि अगर इंस्ट्रूमेंट 1 में अगर क्या है कि अगर होल्डर के पास ऑप्शन है कि वो उसको कैश मिले जो कि इंटरेस्ट के पार्ट में है 6,000 पर एनम और प्रिंसिपल भी मिले 1 लाख एट द एंड ऑफ ईयर 5, सो ये क्या है, ये प्योरली फाइनेंशियल लायबिलिटी है. It is purely a financial liability because it is an obligation at the hand of the issuer to pay, to deliver cash, and it is a right of the holder to receive cash. So it's a purely a financial asset in the books of A Limited or holder, or it is a financial liability in the books of issuer. Purely a financial liability. Instrument 2, if additionally holder of financial instrument is an option to buy shares, 10,000 shares. So 1 bond equals to 10 shares, 100 bond equals to 1,000 shares. Take the option to convert the shares. Then in that case, it will be treated as equity in the books of the issue. So because this instrument is a derivative instrument. Derivative means value depends on the underlying asset. What is the underlying asset? Underlying asset is the debenture, which is convertible. Convertible debenture is the underlying asset on which these option to convert the shares, to convert the bond into shares is there. Settlement after 5 years is there, and initial payment is nil or insignificant. But they have an option to convert the shares. They have an option to redeem the shares. They have an option. Additionally, they have an option to convert the shares. So it's a kind of derivative. It's a kind of derivative which depend on the value of underlying asset. What is the underlying asset? It's an instrument. So because in this case, if option is there, it does not have an initial payment or payment is insignificant. This is an embedded derivative which is attached to the contract and cannot be separated from each other. There is a contract entered by the entity and this option is attached to the contract. It is an option. It is not mandatory. It is an option which is attached to the contract and which is not separated from each other. Main contract is there with that this option is attached. So it is an embedded derivative which is attached to the contract, which is not separated. Main contract is treated as an host contract, which is a structure or base on which the embedded derivative is attached. This contract, main contract, is an host contract. It is the basis of contract on which the embedded derivative or the option contract is attached. Instrument 3 is the combination of financial liability and equity. Like in that case, the cash is to be paid in the form of interest and principal is to be converted into shares. So it's a, in that case, if the fixed to fixed criteria is meeting, then in case of interest, it will be financial liability, and in case of conversion of shares. Now we will take the another example related to this topic, like XYZ Limited Company has issued 10,000 convertible cumulative preference convertible compulsorily cumulative convertible preference shares as on 1st April 2021 at the rate rupees 150 each. The rate of dividend is 10% payable every year. The preference shares are convertible into 5,000 equity shares of the company at the end of year 5 from the date of allotment. When the compulsory cumulative convertible preference shares are issued, the prevailing market rate for similar debt instrument without conversion option is 15% per annum. Transaction cost on the date of issuance is 2% of the value of the proceeds. Date of allotment is 1st April 2023. That is the date of allotment. Date of conversion is 1st April 2028. Number of preference shares becomes 10,000. Total proceeds become 15 lakhs and rate of dividend is 10%, because in this case the preference shares on which the dividend is to paid at the rate 10%, and which is compulsory cumulative convertible preference shares, because 10,000 shares are there which is compulsory converted into equity at the end of year 5. The conversion option, the prevailing market rate of interest for similar debt without conversion option is 15%, and transaction cost on the date of issuance is 2% of the value of the proceeds. Step 1 is to calculate the issue price. How to calculate the issue price? Because 10,000 shares is there at the rate rupees 150 per shares, so it becomes 15 lakhs. So this is the issue price. Calculation of transaction cost, which becomes 2% of the value of proceeds, like calculation of transaction cost, that is 15 lakhs into 2%, that is rupees 30,000. Step 3 is to calculation of liability component. How that is, liability is the dividend. Calculation of dividend paid, how much? The 10% on the issue price, that is 15 lakhs with 10%, that is 1,50,000 each year. It should be paid each year, that is number of years is become 5 years, and dividend is to be paid 1,50,000 every year. So the present value of cash outflow for the entity become 1,50,000 into present value factor at the rate 15%, because the market rate without conversion option of such instrument is 15%, so it should be discounted at that rate for 5 years. So it becomes 1,50,000 into 3 present value factor. So total present value factor for 5 years becomes 3.352. So the present value of the cash outflow is 5,02,823. Now this is the present value of the cash outflow of interest element. Now the present value of the cash outflow of equity. How to calculate the equity? Because the total value of the proceeds is 15 lakhs and present value of the liability component is 5 lakh 2,823. Then the balancing figure becomes the equity component, that is 9 lakh 97 176 becomes the equity component. Now these equity component and on these liability component, these transaction cost is to be proportionately divided. Like step 5 is transaction cost, which is 30,000 is proportionately divided into liability component and equity component. Transaction cost of liability component, total transaction cost is 30,000 and it should be proportionately divided in liability and equity. So the liability amount is 5 lakh 2,823. 5 lakh 2,823 divided by total issue price is 15 lakhs. So it should be proportionately the liability component of transaction cost becomes 10,056. 10,056.47 and transaction cost of equity component, that is 30,000 into 9,97,176, which becomes an equity component divided by 15 lakhs, so it becomes 19,943.53. So each transaction cost is proportionately divided into equity and liability. And step 6 is transaction cost is reduced from the value of the liability and equity. So the value of the liability is 5,02,823, from which the transaction cost of liability component is reduced, that is 10,056 is to be reduced, that is 44 lakh 92,766.80, and equity component is 9 lakh 97,176 minus 19,943 is to be reduced from the value of equity. So this transaction cost is reduced from the value of equity and this transaction cost is reduced from the value of liability. Liability amount is 4,92,766 after reducing the transaction cost, and the equity value of equity will become 9,77,233 after reducing the value of transaction cost of the equity, that is 19,943. So this value is after reduction of transaction cost. Now step 7 is to determine the effective interest rate by using trial error method, where present value of cash inflow is equals to outflow. Present value of cash outflow is, कैश आउटफ्लो क्या हो रहा है एंटिटी का, इंटरेस्ट का पार्ट कितना है, लायबिलिटी कितना है 5,02,823. डिस्काउंटिंग फैक्टर अगर हम 15% यूज करें तो इसका डिस्काउंटिंग फैक्टर आपका आएगा, for 15% it becomes 5,02,823. For 16% it becomes 4,91,144. तो आपको आपका प्रेजेंट वैल्यू फैक्टर 492 का कितना रेट ऑफ इंटरेस्ट निकालना बाय यूजिंग ट्रायल एरर मेथड. बिकॉज 16% डिस्काउंट करके आप 491,144 आएगा. 15% पे 5,02,823 we had already calculated. Now we will find out the value 492,76 किस रेट पे, where cash inflows is equals to outflow. So x minus 15%, that is x represent 4,92,766.80. 15% represent 5,02,823. Divided by 16 minus 15, that is 16% represent 491,144 minus 15%, that is 5,02,823. where x आप क्रॉस मल्टीप्लिकेशन करके इसको फाइंड आउट कीजिए, x का एलिमेंट दैट इज 15.x, इंटरपोलेशन मेथड लगा के x का डिटरमाइन कीजिए, x विल बिकम्स 15.86% आपका इफेक्टिव रेट ऑफ इंटरेस्ट. अब आप एमोटाइजेशन टेबल बनाइए. You have to prepare the amortization table, loan amortization table, year 1, 2, 3, 4, 5, where opening balance for interest component becomes 492,767 and effective interest rate at the rate 15.86%, which becomes 78,153. Coupon is 1,50,000. Closing balance becomes 429.20. 429.20 is the opening balance for the next year. Effective interest rate is 15.86. That is 66,758. Coupon becomes 1,50,000. Closing balance becomes 337,677. These 337,677 becomes the opening balance for the next year. Effective interest rate on opening balance is to be calculated at the rate 15.86, that is 53,556. Coupon becomes 1,50,000. Closing balance becomes 241,233. In the same way, the amortization table is to be prepared at the year 5. It becomes 0. Now accounting entry is to be done at the initial recognition. How year 0, the entry will be bank account debit by rupees 1470. That is how 15 lakhs is the total amount issue price, on which 30,000 is to be reduced. That is the transaction cost. So total bank account amount debited by 1470, and that 1470 is to be credited with liability component, that is 492,767, that is the interest element. 492,767, 492,767, and equity component becomes 977,233. That is the balancing figure, equity component. So the initial recognition, then on subsequent recognition, dividend is to be amortized over the period. Dividend is amortized like in year 1. Dividend or interest, we can say anything, like we will say either the interest or dividend. Interest expense PL account debit by whatever we had prepared in amortization table, that is 78,153, and we had calculated at by using effective interest rate. Interest expense account debit by 78,153. In the same way, the interest is to be recognized to liability component of CFI credit. Then repayment by 1,50,000 is repayment done by the organization, that is liability component of CFI account debit, that is compound financial instrument, debit by 1,50,000 to bank by 1 lakh. So now at the year 5, they had to convert, wholly convert, not to redeem. They had converted the whole amount into shares. So in this case, the equity component of CFI becomes 9,74,233. The preference share capital becomes, because the number of shares in the question is 10,000. 10,000 convertible debentures are converted. The preference shares are convertible into 5,000 equity shares of the company at the end of year 5. So 5,000 shares is to be, means number of shares conversion is 5,000, face value is 10 rupees, so it becomes 50,000. So equity component of CFI account debit by 9,47,233 to preference share capital by credited by 50,000, that is the face value, and remaining amount is credited by to security premium 927,233. In this way, the accounting entry is to be done. Now the concept of financial instrument. Suppose XYZ Limited has taken a fresh loan from Bank B. They had taken a loan from Bank B in order to pay its old loan taken from Bank A, and paid prepayment premium to clear old loan and paid processing fee to Bank B for new loan. So suppose XYZ Limited has taken a fresh loan from Bank B. In order to pay its old loan, which was taken by XYZ Limited from Bank A. So they had previously taken a loan from Bank A. In order to pay that loan, that old loan, they had to take in a new loan from Bank B. And they had prepaid, and they have also paid a prepayment premium to clear the old loan, because the period of the loan is not expired, and before that expiration they had cleared, they had paid the old loan. So the bank has charges, some prepaid charges, prepayment charges, because the time period is of 10 years and they had paid before 10 years, and so the bank has charges some element on that for prepayment of loan. So in order to and also in order to take the loan, new loan, that bank has charges processing fees for new loan. So these two payments, prepayment premium and the processing fee, whether these both the cost will be treated as a transaction cost or not. So payment for prepayment premium, which is paid by the organization in order to clear the old loan, such prepayment premium shall be recognized as an expense in the profit and loss account on extinguishment of original loan or liability. In order to clear the old loan, extinguish the old loan, they had paid some prepaid charges. That prepaid charges is to be recognized as an expense in profit and loss account and will not be treated as transaction cost, because it is not in the nature of transaction cost. It is not an incremental cost in order to go to the transaction. Such prepayment premium is not in the nature of transaction cost of new loan. So the accounting entry will be prepayment premium PL account debit to bank. Unamortized transaction cost of old loan. If the unamortized transaction cost is left, suppose there is a period of 10 years and that transaction cost is to be amortized over the period of 10 years. So if it is prepaid before 10 years, so there is some amount left, unamortized amount left, like for 2 years the amount is left for recognition. That amount, unamortized amount, also is to be charged to profit and loss. It should be transferred to profit and loss. And accounting treatment of processing cost of new loan, how they will account it for? They will reduce from the value of the new loan. Whatever the loan is taken, it should be reduced as a processing fees from the value of the loan. Such transaction costs shall be amortized in PA in the form of interest. Interest is to be calculated at EIR basis. Effective interest rate basis, it should be calculated. So in this way, the compound financial instrument transaction is to be done. Liability versus equity criteria. How the liability is to be treated, how the equity is to be classified. In case in Ind AS 32, how to present the financial instrument, that is equity versus liability. Dividend, if the dividend is discretionary, means not mandatory, it is discretionary at the management decision whether it will be payable or not payable, it will be decided by the management, then that dividend is to be treated as an equity, not a financial liability, because it is at the option of the company and it is not mandatory payable. When the dividend is mandatory payable, then it will be treated, it will be recognized as a financial liability in the books of issuer, because there is an obligation to pay cash. When the financial instrument is redeemable, when it is redeemable, compulsory redeemable, then it will be treated as a financial liability. When the financial instrument is convertible into equity share and it will satisfy the fixed to fixed element, then it will be treated as equity. If it will not satisfy the fixed to fixed criteria and the number of shares are variable, then it will be treated as a financial liability. Fixed to fixed criteria means the number of shares to be issued are fixed and the amount of consideration of such shares are also fixed. If they are satisfying, then it will be treated as equity in the books of issuer, and if it will not satisfy, then it will be treated as financial liability in the books of issuer. Now, when the financial instrument consists of redemption option, when there is an option to redeem, and where the redemption option is available to the hand of holder, if the holder will choose to redeem its instrument, then that instrument is treated as financial liability, as the issuer cannot avoid the payment of cash to the holder. When redemption option is available to the issuer, when redemption option is available in the hand of the issuer, not in the hand of holder, then when the issuer will opt to redeem, when redemption option is to be exercised, when redemption option is to be exercised, then it should be treated as financial liability. But when conversion option is to be exercised, then if fixed to fixed criteria meets, then it will be treated as equity. If fixed to fixed criteria fails, then it will be treated as a financial liability. In Indian scenario, preference dividend is generally considered as discretionary, as the approval of shareholder is required. If the shareholder does not provide their approval for payment, such dividend shall not be paid. Thus, no obligation for payment of dividend. Then it should be treated as an equity because it is discretionary in nature. Thanking you for watching my video. We will discuss the remaining topic in our upcoming videos. If you like, please share, subscribe my channel. Thanking you for watching.